3.
Welcome, Consumer Quarterback Show Overtime podcast here. Brandon Rhymes coming from our home, actually, right here in Pinellas County on the beautiful lake here in Tampa Bay. And I want to introduce our special guest, attorney and CPA, Michelle James. Welcome.
Yes, thank you. My God, it is a beautiful day.
It really is.
I'm a little distracted looking at all the action on the water.
I know, right? The boaters out there, people enjoying this Tampa Bay weather.
Absolutely. It is beautiful out here.
Nice, yeah, it really is.
Thank you for the invite.
Hey, my pleasure. So Taxpro of Tampa Bay. So today what we wanted to do, we wanted to dive deep. So if you're familiar with our radio and TV show, you know, we're kind of stuck into or relegated to a 48-minute, 1-hour show, basically. So what we wanted to do is spend some extra time with Michelle today to talk about tips and strategies, tax strategies, especially some of the new changes with the new administration and what we can expect from the IRS. And we're going to talk about everything from audits to business strategy to 1031 exchanges. And even for the solopreneurs out there, I think everybody can get something from this show today, because there's a lot of tax strategy that people may not be aware of, Michelle.
Absolutely. Absolutely. I see it every day.
Yeah, exactly.
Yes.
And also, you know, if at any point from the show today you want to reach out, we have a hotline number you can call, 813-750-0550. That's an off-air number. You can call or text that line, 813-750-0550. That's our consumer advocate hotline, and consumerqb.com. You can submit an email form right there at consumerqb.com, and that email form will come right through to myself and my team. So any tax questions, business questions, or even any introductions to, you know, our 80+ show partners that we have of different categories of business and finance. But today we're going to dive deep. We've got a great legal brain, a CPA brain here, and you know, these are great tips and strategies for folks out there maybe looking to grow their business, looking to minimize the amount of taxes that they're paying, maybe buying real estate investments. You know, what's the best entity to purchase in those investments. So let's jump right into it. So Michelle James is here. She's our tax strategist, our expert contributor on the Consumer Quarterback Show for all things tax and business strategy. So you know, some of the first things we wanted to talk about was right now, I think that people have an option to extend, and then COVID-19, of course, comes into play too.
Absolutely. So we know that the dates have been extended to May 17th. However, the date is the extension to file.
Okay.
Not the extension to pay. And I think a lot of people get so confused about that, because then they'll hold off on paying, and then they've accumulated all these penalties and interest at the time when they do decide to file. And they're like, well, I was on an extension. Well, yes, the extension is just an extension to file, and we need to keep that in mind. It is not an extension to pay.
Okay. Yeah, that's important. That's
absolutely.
So differentiate between the two.
Yes.
And then, of course, is that due to COVID-19, or is COVID?
No, that has always been the IRS's policy. The extension is only just to file. It is not to pay.
Okay.
So people go, well, I don't know how much I owe. I don't know what it's going to be. So what do I do? I tell you, refer back to the prior year.
Okay.
So usually when a client gets in touch with me, I'll say, listen, I need to see your prior year, because this kind of helps me to determine what this year needs to look like,
right,
or some things that you've needed to do in the past prior to even contracting me.
Right.
And so when they come in, that previous year, usually is the telltale sign of what it is that they need to do.
Yeah, that's it. That's important also. And think about it from a business perspective. If you have an opportunity, you can look back, I believe, up to 3 years.
Up to 3 years.
You can look back and say, hey, you know, somebody may have left something off, or maybe you went into one of the, you know, kind of the strip mall, you know, businesses where they, you know, they have employees sitting there, you know, just pushing forms. They're not really a strategist as much as Michelle may be. So you can do a review for up to 3 years and find sometimes money sitting there that they just kind of left on the table. Absolutely.
So for the person that has not filed 2017, you will need to file by May 17th, by April 15th in order to qualify for any refunds that you were due.
Okay.
Okay, so if you are 2017 and older, 2017 older, you don't get it. 2017, we can get you in. If we get you in by April 15th, if you were due a refund, they will still honor that.
Okay, that's
Other
awesome.
than that, it is for the IRS to keep.
Yeah, right. So it's often they say not what you make, it's what you keep, right? It's not the money that you make, and of course we all work hard to make money. If you're making calls, you're doing sales calls, or you're door knocking in real estate. I mean, there are lots of ways people make money, but the key, and I shouldn't say make, I should say earn money. It's what you keep, and the strategy comes into play. That's where it comes into play, having multiple entities in some cases,
Yes.
writing as much as you can off.
Absolutely.
Just in general, that's just a lot of people get into a business and they start doing it in their own personal name. Now you're talking about liabilities if they get sued.
Mm-hmm.
There's so many implications.
And I still see it every day. We have our business owners that kind of jump on Sunbiz and go, I got it. I got it. I created my entity and this is what it is.
Yeah.
Well, that particular LLC that you may have created on Sunbiz just simply says that you are a limited liability company.
Right.
That does not determine how you will be taxed.
Okay.
And in order to determine how you will be taxed, you actually need to kind of sit and talk to someone to see what best works for you.
Okay.
Right? Because being taxed as a disregarded entity, which is the automatic default
Right.
for a sole person that has set up an LLC, is not the most tax advantageous.
Okay.
Okay, so I see that quite a bit. I see they kind of jump on to Sunbiz and they kind of create it. Well, that just gives you the permission to operate in the state of Florida.
Right.
That does not in any way determine,
Right.
what the tax benefits or how you will be taxed. Now, the other thing is being able to operate in the state of Florida. That has nothing to do with what you are required to do for the federal government.
Okay.
Right? And so I think that's the part that they miss sometimes. It's,
Yep.
I'll just go ahead. I don't want to pay someone else to do it, so I'll just go ahead. But here's the thing. You set your LLC up, and then you start the commingling of funds.
Right.
Well, automatically, you have lost all protection
Right.
of your limited liability company.
Yep.
And so because they don't understand what that is,
Yep.
automatically out the gate, they have lost that actual legal coverage
Yeah.
they actually thought they were going in for.
Exactly.
So they'll, go in and they'll just transfer their personal accounts and they're back and forth and they're transferring back and forth, back and forth. Well,
Yep.
that is considered a commingling of funds.
Yeah. Yeah. Absolutely.
Right? And I think that's the part that our small businesses miss a lot of times.
Yep.
When they don't consult
Yep.
someone that, whether it's a legal or accounting purposes, they don't consult that person to ask, well, how do I make sure
Yeah.
that my actual home, all the things that I've worked so hard for,
Yeah.
is protected against any kind of lawsuits,
That's
right?
right.
You open a pressure washing company and you run out here and you create an LLC.
Yep.
You break some things on the way. You kind of do some damage to some, pool fences and things like that. Well, here's the thing. I can come after anything that you own because maybe you have started to commingle.
Yeah. Yeah, exactly. They can pierce the corporate
You
veil.
pierce the
They go
corporate
after
veil.
they go after other assets. You cause this much damage, and so that's a strategy, and you got to be careful about that. And then the other thing is, a lot of times people, they incorporate so they can put CEO on their business card.
Right,
It looks good,
right.
right? It looks cool.
This
I'm the
looks
CEO.
great.
Yeah. But they don't understand everything that goes along
Right.
with it.
There is certainly much more that goes along with just opening up that LLC, and more. I do quite a bit of classes for the SBDC here in Florida, SBDC. I do some for the Small Business Development Center. I also do quite a bit for the Chamber of Commerce that have the small businesses coming in. And really, that's what you see. You see these small companies that, they don't want to pay someone to kind of help them or assist them along the way.
Yep.
And so they jump in and they jump on Sunbiz and they're like, I've got my corporation.
Yeah.
And I was like, well, how are you being taxed? They're like, well, I don't know.
Yeah.
Right. And I was
Exactly.
like, well, two different things,
Yeah.
right? if you've set up something on Sunbiz and you have a partner, your automatic default with the IRS is a partnership.
Okay.
But that doesn't necessarily mean that that's the most tax advantageous
Right.
setting for you to have, right?
Okay.
So whether you're a sole proprietor or a partner, my preference is actually the S corp.
Right.
For our
S
use,
corp,
right?
an S corp, and then you got C corp. So can you just quickly break
So
down the
our
difference?
S corp is what we call a pass-through entity.
Okay.
So, and it does just that. It takes all the income that you've generated throughout that year. It takes all the expenses, and the net passes through to the owner.
To a personal tax
To
return.
the personal tax return. So I issue you a K-1.
Yep.
To you, that's pretty much a W-2.
Right.
You take that W-2, and if I'm not the accountant in charge, you take it to your accountant. The accountant goes, okay, so we have a K-1 for Brandon. And with that K-1, it kind of determines whether you have a loss or whether you have a gain. At that point, that is where you're taxed on your personal tax return. The nice thing about the S corp is it has no tax
Okay.
attached to it at all, right? Zero. So whether there's a gain or whether there's a loss, there is no tax implications on a S corp, which is why it is my preferred one for my small businesses, because
Yep.
it kind of allows us to kind of do some things to kind of shelter and to reduce that tax liability that our small business owners get.
Yeah.
Because if I can get you to, you know, set up some things, set up some payroll, set up things just a little bit differently,
Yeah.
then now I'm able to kind of keep you in that game of reducing that tax liability.
Yeah. Because small tweaks are gonna make big differences.
Oh, absolutely. You know, I think the part that we always miss is, so we've gained all this money and now we've not paid any taxes on it. Well, what's wrong with paying yourself? Now the company gets to deduct that as well as the taxes that's paid on your behalf,
Okay.
right? So we've now lessened the actual net income.
Yes.
We've actually paid some taxes on your behalf, and now we issue you a W-2 and the K-1.
Yes.
So now, because I don't like to see my business owners in tax trouble. So
Right.
I tend to try to find out how do we eliminate that whole tax issue?
Yeah.
And the way we eliminate that is using it through our S corp.
Right.
We use that to eliminate those taxes. We use that to reduce our income and to eliminate those taxes.
Yep.
And I think that's the part that we miss sometimes, because as a sole proprietor, you of course now subjected to self-employment taxes. We know that's at 15.3%.
Yep.
You know, half of that you're still at about 7.65%. However, it's an unnecessary tax for you to pay as a business owner.
Right. Right.
Right? So when you go on Sunbiz and you set up the LLC, that's your automatic tax default.
Yes.
It's what they call a disregarded entity for a sole proprietor.
Okay.
And it puts you at such a tax disadvantage. I usually find people not wanting to file,
Okay.
and if they do file, they're not being very honest
Okay. Got it.
because of the tax implications.
Right. Right.
Right? So you get there and you're like, okay, now let's file, and there's just so much that is owed at that particular point that now we need to start figuring out what to do, right? And in your world, what that converts to is the person that can buy the home on their tax return, it doesn't show that they can afford
Right.
the home,
Right.
which is not necessarily true.
Right.
In
Yeah.
your world,
It's the catch-22.
it's the catch-22.
Yeah.
Because in my world, they want to reduce their taxes, but in your world, they need to show the income.
That's right. Yeah, they
Right?
want to show the income so they qualify for the mortgage, get the better rates, et cetera. Their
Yes.
debt ratio has to be a certain place. So unfortunately, you know, a lot of people know the drill. I mean, there's cash businesses that hide it. There's a lot of ways to write it off. So yeah, that's a challenge that you see, but there's a solution to that also.
There is. You don't have to do that. You do not have to be on that Schedule C.
Yep.
And that alone will reduce your taxes by literally hundreds and thousands of dollars.
Yeah.
Like, I will show you that literally when you bring me that tax return.
Yep.
I'll say, okay, this is what you made throughout the year. Now times that by that 15%, and then now your personal tax rate of about 10%, and that's on the low.
Wow.
Right? We also know that that tax rate can go up to about 37%.
Right.
So it's important that I think our small business owners understand that there's a way out.
Yes.
They just need to seek the expertise of someone who knows
Right.
how to help them.
Yep.
Because if you bring me a set of financials, a typical accountant is just going to prepare the returns. And you can't knock them for that. We're
Right.
not salespeople.
Okay, got it.
Right. We're not salespeople, so we're not going to sit here and try to get you into, oh, listen, if you go this way, this would be more tax advantageous for you. We are just going to prepare it based on the way that you've handed it to us.
Kind of like a consultant,
Absolutely.
It's more of a consultant approach, an educative approach where you're saying, hey, have you ever thought about this? What if you added this to your tax strategy, your portfolio?
And there's so many different things we can do. When you have partners, we can do reimbursement allowances. There are so many things that we can do, and those are the things that they miss because they're so, trying to save on whatever that tax fee is per year or whatever it is, whatever the reason is.
Yep.
I've always found it to be pretty much insulting considering how much we actually would charge for a tax return.
Right.
Why would you not consult someone just to figure out how that should work?
Yeah, there's sometimes small things
It's
you look
minuscule.
at it. Like there's a small thing too called a a health savings plan.
Oh, the health savings plan.
Pre-taxed money.
Absolutely.
It's not a big deal, but it's still
and
it
it
adds
absolutely helps.
Right.
Those IRA deductions and contributions also help.
Yes. So
Right.
let's talk about IRA, but before I just said we talked about an S corp and then there's a C corp too, correct?
So the C corp, I would tell you to please stay away from.
Stay away from just in general.
Absolutely. Or Google's, Amazon, Microsoft, right? Those are the companies that are filing the C corp tax returns.
Okay.
They are certainly not for us.
Okay.
They're not tax advantageous, and that does not mean that they don't have their own tax advantages.
Okay.
But we, because of the type of income that we're making, we really should not be playing in that.
So it's like a level above
game. Absolutely.
bigger companies.
You don't
Okay.
really want to do that. The corporation allows you to have a certain amount of shareholders, which we don't usually have to worry about either.
Right.
Right?
Yeah.
So there are certain advantages and reasons why you need to use that. And one might be that you're a publicly traded company.
Right.
Right? And so we want to stay away from that 1120 altogether if we can.
Let me ask you a question too, kind of just you hear on the different talking heads on the news or whatever, some of these companies, they're not paying any taxes, or you hear like, oh, Amazon paid 0 in taxes last year, or some of these companies. Why is that, and how do we justify that to the people, the average person who says, well, I pay a lot of money, I pay a bunch of taxes. Why should these big companies get away with very little to no tax rates?
Because these are the business tax credits that we have in place for the companies.
Okay.
Right. For hiring, we have tax deductions, right? For keeping people employed.
Yep.
Right? We keep you off the system. And so as these businesses are keeping you off the system, we're also keeping the economy going. And so we get some tax credits for that.
Yeah.
So there are a bunch of tax credits, including if we own property, we're getting depreciation on our property. We're getting a Section 179 on the equipment that we're buying. We have employees that we're getting credits for.
Yep.
And so there are all these credits.
Wow.
That's allowed. And so these businesses are allowed to take these credits because of the type of money that they make.
And that's a federal problem. Most of you were talking about federal, right?
Absolutely.
And then there's state too.
And
like,
then
for example,
there's those state,
yeah,
right?
like people like right now, Austin is such a big boom. You got a lot of the Silicon Valley, Menlo Park companies moving there, and it's changing the whole political scene and the scene in Austin, Texas. So speak to that too, because local areas, a lot of times, for example, I just had a meeting with a commissioner up in Pasco, and we were talking about different things that they're doing up there to draw folks, jobs, infrastructure, Pasco County is a great draw now for sports teams, and they've got a big project going on with a couple of the lagoons that they're doing. So that's unique how areas compete to draw talent in as well.
Absolutely. And again, we get credits for those.
Okay.
Right. We start talking about, what we're going to discuss next is probably those opportunity areas. Right. Those areas that you're allowed to kind of go in and make a difference.
Yeah.
Right. It says, listen, I'm getting ready to go in and invest.
Yes.
I'm getting ready to make a difference for the people that live here, for the properties that are already here. We're getting ready to increase value.
Yes, exactly.
And so the IRS then at that point starts to give you tax credits for that. So there are so many different ways that you can gain those tax credits. Just kind of got to know how to hone in. And so I know a lot of people are mad when they hear, oh, they didn't have to pay any type of taxes, and it's not necessarily so.
Because the other thing, too, is if you overtax them, they're going to just move overseas.
They're going to move overseas, right? And we're going to start looking at those people that are working on, right? Your Fivers and your Fiverr, whatever you might call that, right?
That's right.
All those different sources where they do those outsourcing is what we'll end up doing because we can't afford to have our businesses here in the U.S.
Right. Yeah, if they change it too much. We kind of touched on it earlier. IRA, such a big point with the real estate business. By the way, if you just joined us, I'm Brandon Brimes. This is Michelle James. She's an attorney and a CPA here locally in Tampa Bay market. Taxpro strategy here in Tampa Bay. Taxpro of Tampa. When you look at the IRA, that is a very unique vehicle, basically. Describe it as a vehicle to be able to buy properties through an IRA.
Absolutely.
And then you're taking advantage of a lot of different tax incentives and reasons why people may want to do that.
Yes. So they offer these IRAs where you are able to go in and kind of use your account as a collateral without actually using those funds, and purchase the property and take the tax advantages of the property, and still have your money still sitting in an IRA. Those are definitely favorable to that person that wants to, has a great balance sheet. They have a great financial statement, and so those funds are kind of sitting on their balance sheet, but yet they're able to use that to go out, secure property, buy these property, and then turn around and take the advantages such as depreciation and all the other tax benefits that we have as owning property.
Yeah.
Right?
Exactly.
I tend to, I must say real estate is my go-to for my clients that are making that amount of money, that are kind of, doing really well, right? You're doing kind of better than that middle class, and you're kind of heading into that six-figure income and a little bit above. You're at 150, you're heading to 200. Real estate is really outside of a W-2 is the only thing that can help you.
Yeah,
right?
Exactly.
You're right. You're on a W-2 for $350,000 a year.
Right.
And you're like, well, what can I write off? And I'm like, I don't really have anything. Like,
It's
all
too
personal
cookie
deductions
cutter.
are gone, right?
Right. It's
all
just...
your personal deductions are gone. But how do I help you?
Yeah.
Well, maybe at that point, what we need to do is to set up an LLC and to start buying that property within the LLC, and now pass that through on a K-1 to your personal tax return.
Yeah.
As a owner, if you're making $350, you can't buy that in your individual name and get those same tax benefits.
You could, let me insert something here too, because it kind of goes relevant. So we were just talking about Amazon and how they started, and what they did is they started. They had so many investors, they weren't making money for a long time. And now what they did is, of course, they're dominating sales. They're selling a lot. They're selling online. I mean, talking billions of dollars in sales in revenue. And then what they're doing is they're offering shipping services to a lot of these small business owners.
Yes.
And they're offering those shipping services as a loss. So it's a loss leader for them. So then they can offset that on their books.
Yes.
So that's a strategy. That's a big time.
Absolutely. That whole drop ship.
Yeah.
That was a term that we heard way back, and you're like, what does that mean?
Yeah.
Right? Now, at this point, you hear them actually now making money because, these we'll go on and we create these accounts and
Yep.
we're selling and people are buying, and Amazon is actually doing the actual shipment for that.
Yeah, you're selling a pair of glasses online for X dollars. You're selling them, you're making retail, you're buying them at wholesale. Somehow you have a hookup there. And then Amazon for a long time, I don't know if they're still doing it, but they would package and ship stuff very cheap and they would lose money on that. So they're paying people more money than it would cost. So anyways, that was an offset on their books. So a brilliant strategy. And of course, they also own a lot of the AWS, the web services. So they actually run a lot of the federal governments. A lot of we saw what happened with Parler, the conservative social media. They said, nope, we don't like what you're doing. We're going to pull your platform. So they have invested a ton of money in infrastructure too.
Yeah, I actually have a client that was making about $1 million per year. And then he kind of called me up and he's like, oh, Michelle, I think this business is going away. And I'm like, what do you mean? He's like, it's going away. Amazon, which was his primary source of distributing, right, had now signed a deal that said he could not distribute this particular vendor.
Yep.
And of course, it was against HP. So HP won.
Wow.
Our small vendors lost. And so, he actually lost his business just like that. That's
one of the things that frustrates me the most right now with this last year with COVID-19, the Chinese virus, whatever you call it. What it was a power grab by the elites, a power grab by the wealthy, and they, the top earners, the top 1% increased their net worth by, I've heard both numbers, $500 billion to $600 billion. They increased their net worth last year when so many small businesses went out of business.
Losing.
So many middle income earners are losing.
Yes.
And so it's the disappearing middle class, and the rich and the elites are getting wealthier and wealthier.
And we saw a lot of that.
Yeah.
We have seen a lot of that over the past year. So it's, but what do you do? How do you stay in the game?
There you go. You got to
figure out how to stay in the game.
You got to find out where the money's
at. You have got
at.
to figure out how to stay in the game.
Exactly.
Those self-directed IRAs are one way to kind of stay in the game.
Okay.
Okay. Use those monies that are secured elsewhere to go ahead and obtain property and kind of then take the advantages, the tax advantages of these different things that are offered to you, right?
Yeah.
The opportunity zones are a big one.
That's such a key word.
That's a big one.
So what is an opportunity zone, and how does that matter? Why does that matter to an investor?
So the opportunity zones are designated out. You can actually search them, and they're all on the websites. They're listed as opportunity zones.
Yep.
You take the funds that you have actually, you take your monies and you go and you invest them into an opportunity zone. The IRS says, well, go ahead and we'll waive whatever capital gains you were being charged on those monies that you made because you took your money and you used it for good, right? You kind of put it in those zones that now show that we need to improve, right? We're improving property, we're improving the neighborhood, we're giving jobs, we're doing different things.
Yep.
And so for that, your tax credit,
nice.
Again, right? Because even the small people can get those tax credits.
Yep.
They're not just for our corporations, right? We just have to learn where to go to get these tax credits.
Right.
And one of the tax credits is these opportunity zones, and investing in them and investing whatever income you have. You've sold a property, you're holding on to some cash.
Yeah.
Go into an opportunity zone and then buy.
Yeah.
And then improve that property.
A practical example would be I bought a duplex or a triplex or a quad in an opportunity zone. I'm going to have extra incentives from the government to do that.
Oh, absolutely.
Yeah.
And even the SBA funds an opportunity zone and gives you the advantages because they're going to make sure that they're going to ensure that you get that loan to get that property. So there are also the advantages coming in from the bank.
Yeah.
As it's coming in from the IRS.
Yeah, from the lending side. I just closed a restaurant deal last week. It was just shy of $1 million closing that we had. And it was very interesting because the SBA backed about 50% of the deal. The conventional lender, or I'm not sure if it was conventional, but there was a local bank, regional bank maybe, that did the other 90%. So the actual client, the borrower, the purchaser, came in with like 10% down, and they bought an existing business. They had cash flow already.
Immediately.
A lot of the employees wanted to stay and run the business anyways, so it was a win-win.
Definitely. And I love that whole idea of acquiring
Yeah.
businesses. Definitely my mantra. I won't usually go through the trouble of starting a company.
Yeah.
I will normally acquire something that's
Nice.
already
Yeah.
up and running and has some goodwill to it.
What's an example of that? I mean, like, for example, I've got a body shop for sale right there in Tampa on MLK. You know, it's been in business for 45 years. So Gil's Body Shop, by the way, is available for sale if you're watching this. So, you know, somebody that's an entrepreneur, they're thinking outside the box, they maybe even own another location. They buy that location that's been there for 45 years, doing good work. Obviously, they wouldn't still be in business, right? Has a lot of business coming in, as much business as he can keep. And he's got it listed for like $499,000 for a corner lot in Tampa, close to downtown, close to the malls, close to I-275.
How long has he had it listed?
We just listed it a couple
Just
weeks.
listed.
Yeah.
So, you know, a lot of the issues that you have with that is someone coming in like myself,
Yep.
and your financials just don't tell me that
Right.
this is actually worth what you're asking. Doesn't mean that's not what it's worth.
Yeah.
So we won't mistake what it's actually worth
Because there's a lot of times cash.
It's what I'm looking at.
Yeah.
And what determines what it's worth
Yeah.
is that tax return.
Yeah. Yeah,
Because
exactly.
then I can take that tax return to the bank and get the funding that I'm looking for to purchase your business.
Yeah.
But if your tax return does not show
Yep.
what I need it to show, that it can actually substantiate a debt for $500,000, I am not going to get the funding to do so.
Right.
And so now we're getting into this little thing of where we have to haggle.
Yeah. Yeah.
Because I don't have the cash, but I'd really like to buy it.
You negotiate, you work a deal. You maybe even do seller financing sometimes. You know, people.
Yeah, well, that's what they have to resort to.
Yeah,
Yes.
there's an advantage there for seller financing, especially for somebody that's in a high tax bracket. They may not want to realize all that income at once. Can you speak to that too?
Sure, absolutely. Those seller finance deals are always great, right?
Yeah.
Get a little bit of money up front. They report that, and throughout the year, you get to write off the interest
Right.
as a deduction for what you're paying for the business, and the seller gets to recognize minimal income throughout a certain number of years based on however many years they've kind of agreed to.
Right.
So it kind of works well for both parties.
Yep.
You walk in the door, you're making money. It's always a sweet spot.
Yep.
I tend to love that sweet spot of the existing businesses, and even if you're taking the money out, and I think the part that we miss is when we start doing that whole let's purchase someone else's entity is, yes, it costs more than the one you would have to open.
Okay.
Right? Definitely costs more, right? If I went out
Yep.
and I got,
Yep.
I got a space and I tried to start the business just pretty much on my own, what happens is I don't really have that recurring income coming in every month, but I certainly have that expense every month.
Right.
And I think that's the part that, we miss, right?
Right.
When we walk in, we have that automatic, we walk in and
yeah.
what they call that, a key, what they call that, the turnkey.
Turnkey,
A
yeah.
turnkey operation.
Yeah.
And so we walk in and immediately, first month, I might have handed you $100,000.
Yep.
But first month, I'm making $10,000, or I'm actually seeing $10,000 in cash coming into my bank account.
Yeah.
And so what it does, it actually starts creating that cash flow.
Right.
Because the cash flow is what's important.
cash is king,
The
right?
money sitting in your bank isn't as important as the cash flow
Especially now.
that you cancel. Absolutely, it's the cash flow that you can show continuously.
Yeah. Yeah, and that's a key point is, it's not if you build it, they will come. I mean, yeah, you're going to get lucky and you're going to have good locations and people will come in certain cases. But yeah, the idea, I love that idea of acquiring another business. That's one thing we're looking at right now is acquiring another real estate company to grow our sales. And then you also buy that book of business that they have.
You do.
And with Keller Williams, we've got some great tools and strategies that help us maintain communication with that database. And it's a way that you can really grow your business big time.
Right. I actually did acquire a facility in the healthcare department a few years ago, and I wouldn't do it any other way.
Yeah.
If I had to go back and do that again, I would definitely be doing another acquisition and not a full-on purchase.
All right, so we got a bunch of notes here. I'm trying to keep it rolling here, but I think a 1031 exchange would be something good to talk about. And also, are there any changes coming down to anything that we've spoke about? I definitely want to get to 1031 exchange and also audits, how to handle an audit.
Sure. Coming down the pike, we have a couple of things. We know all about the stimulus checks, which they drive me crazy every day. My stimulus check. You need to call the IRS. I know nothing about the stimulus checks.
When they're coming, you mean?
Or when they're coming, or if you'll get one, or where did it go? I really don't have that information. That is directly from the IRS. However, we've got a bunch of child tax credits that are coming. So there are some more advanced payments that are coming in the future.
Okay.
So they're not stimulus payments, but they will be advanced payments on the child tax credit.
Okay.
So I know a lot of people had those questions. Well, what are some of the other things that are coming down the pike? And that's one of the other things that are coming. They're offering, I believe, between $300 to $500 per month.
Per
child.
Per child, right?
No, not per child. Per month through June through December of 2021.
Okay.
So yes, if you do have 2 children, that would be per child.
Per child.
My correction. And so yes, we are definitely looking at some really nice tax credits that those who have kids, will be able to take advantage of.
Okay.
So that's one of the new things that are coming. The unemployment refund, right? For those who kind of filed with us really early, that will start in May.
Okay.
For those people who, kind of jumped the gun and we kind of filed really early and then they went and they did the exclusion for that unemployment benefits, now that refund will come out in May. So those are some of the new things that are coming out right now.
Okay. Yeah, that's awesome. Great stuff. There's a lot of tips in here, a lot of nuggets from what we're saying here. So we want to give out our hotline just in case you want to call and get in touch with Michelle. She's right here in Tampa Bay, 813-750-0550. Call or text 813-750-0550. We'll put you in touch with Michelle. And also consumerqb.com. You can submit an email through the website at consumerqb.com. So we talk about 1031 exchanges. That's such a key part. I've heard some rumors like they might be trying to do away with that. I hope not.
Yeah, there are rumors, but it's still here.
Okay.
So what we'll do is we'll take advantage while it's still here. There is a lot of change in the administration. There's a lot of tax laws that are being changed. There are a lot of tax benefits that they're giving to these companies now. I mean, even just as a small company, we get that QBI benefit, the qualified benefits. So there are still some benefits out here for us smaller companies, and take advantage of those, especially in real estate. It's 20% off the bat. I made $100,000 in rent. 20% off the bat is non-taxable.
Nice.
Now, let's minus out our mortgage interest, our taxes, our property maintenance, or, all the different things that we have to pay for, and our depreciation, which is always a plus. And now we're definitely in a great position tax-wise. Tax-wise, right? Because what we've done is we've take that income that we've actually gained and we've been able to minimize what the tax liability is on that. As far as the 1031 exchange, I absolutely love the program. I think what a lot of people don't realize is they need to know that that's the way they're going prior.
Yeah, you got to identify the property.
Know it. You have to know it before.
While you're in escrow, right?
Absolutely. You have to know before you actually go through the deal. You cannot change this at any point. Oh, I decided not to. So what you'll want to do is you'll want to do your homework prior to trying to enter this. The 1031 exchange is what they call a like-kind property exchange. So it'll be, they don't honor anything personal. So it's a business for business. I have a business and I own the real estate. The real estate is $350. You're trying to buy it, but you have another property that you can sell in order to buy mine, and so we get into an agreement of a 1031 exchange. what that allows you to do is while you sell that property, not to realize the capital gains
Yep.
on that particular property that you have sold, turn around and reinvest it.
Yeah.
Hopefully, my company cost more.
Yeah.
Because if it doesn't, then you still can recognize some of that taxable income. So that's pretty much called the boot, and it is the tax difference between what my company would actually be worth and what you're paying for.
Okay.
So you kind of want to make sure that the company that you're going after is actually either equal to or more than
Right.
what it is that you are recognizing in capital gains.
And it's also, you know, for example, a strip mall or a raw. It could be raw land, right?
It could be raw. It can be raw. It can be new buildings.
Commercial buildings.
It can be new commercial buildings. It could be a new
buildings.
building. You know, I want this, and in return, I'm coming to get that new building that you are building out for me. So it can also be new buildings.
Yeah.
So the 1031 exchange certainly does offer a lot of tax incentives for our buyers that are out there.
Right.
There are some rules and some guidelines that you need to kind of pay attention to when you are doing that tax exchange. And a couple of them is your timing. You have got to watch that timing. You're within some strict guidelines to make sure you reinvest those funds.
And here's a tip too. Like if you don't know exactly which property, you can identify more than one.
Absolutely,
you can identify, hey, I might buy this one, I might buy that one, I may buy this one.
Right.
And then that way you're not locked into one asset. You could say, okay, well, I thought I was going to buy that. The numbers didn't match up, but I'm going to go ahead and buy this one on XYZ Street.
Right. Once you have that qualified intermediary in the process, you can certainly choose more than one property, and then you can go about the business of trying to decide what works best, because you still get all the benefits of buying the 1031 exchange. You still get an opportunity to review their books, review their rent rolls, review whatever is going on. So you still get that due diligence period that would be offered to you, but you are definitely moving at a pace that you kind of need to stay within, because those guidelines are tight in order to conform with the 1031 exchange.
Yeah, I like it. This is great. This is great stuff, by the way. I mean, if you are, you know, in the business or thinking about investing, I mean, you want to really consider real estate as a tax investment through one of these different vehicles, an IRA, a 1031 exchange. There's a lot of ways you can save money, especially when you look at the tax or the stock market. Look at the other options that you have for your hard-earned dollar right now. Bonds are very low yield. You look at the stock market, you know, Ray Dalio just came out a couple days ago and said there's definitely something looming there in the stock market, and Ray Dalio is one of the most recognized investors in the history of the planet. So think about that. If you want to put money into stocks, you got to be really good at picking stocks. Think about something like cryptocurrency, for example. And I know people love it. There's some really, you know, characteristics that people like, but the government could come out one day and say, hey, you know, all these guys with Bitcoin and cryptos and all these different things, they could come out and say, nope, we're not using it. You cannot. So really consider where your dollar is going and where you're going to invest. And if you're earning an income, you know, Michelle can help you save a lot of money when it comes to your bottom line, you know, putting properties through that. We're going to go next to trust and estates.
Yeah, so let me just kind of point out some of the rules for the 1031 exchange.
Okay.
One is the real estate must be used for investment or business purposes.
Okay.
The replacement property must be identified within 45 days and purchased within 180.
Yep.
So we talked about the deadlines. I just want to make sure we kind of give those strict deadlines for you.
45 days of the closing?
Yes,
okay.
45 days and purchased within 180 days.
Yep.
And so you do get those 3 properties that you can kind of keep your eye on,
yep.
but there is still that time frame that you need to adhere to. The value of the replacement property is less than the relinquished property. The difference would be taxable. So
yep.
I also talked about that a little bit. And again, let's go into those opportunity zones and create those tax credits.
Yep.
All right, of that tax deferred investment that you would have. So the IRS, they allow you to kind of defer whatever capital gains once you go into an opportunity tax zone
Yeah.
and purchase you can't get better than that if you're actually a real estate investor.
Yeah.
Right? You're flipping properties, you're constantly moving money. You go and you drop all your gains into an opportunity zone.
Yep.
And now your taxes have been deferred, if not eliminated.
And that's another good point too. For example, with a seller finance deal, a lot of times people say, well, where does seller financing come into play? I don't understand it. But just think about it from this perspective. From the seller's point of view, he may not get his price, but he may get terms. So if you give him terms that he likes, for example, hey, I'll put $50,000 down. I'll pay you a 2-year balloon, 3-year balloon. I'll pay you that money at 5 or 6% over a 25-year amortization. What he's going to like that because he's going to get monthly payments. He's going to say, okay, well, this person is willing to pay me money down, so that way he's got skin in the game. And if you have to foreclose or et cetera, evict, et cetera, plus he's getting structured payments over time, so he might be collecting $1,000 a month, for example. And then he's not going to get hit on taxes. Whereas if he sold the whole building for $500,000, he's going to get a pretty big hit on taxes.
He has to recognize that up front. And again, the 1031 exchange can be done even if you do have a mortgage. So you can agree to even cover the mortgage of the party that's selling.
Perfect.
And with proper estate planning, any kind of accrued deferral capital gains can be completely eliminated. So that is
Proper
absolutely,
estate planning.
yes, that is definitely the key right there in the 1031 exchange, because what you're trying to do is to make sure that your capital gains totally gets eliminated.
Yeah. And then, it comes into like the death tax as well. This is something that really killed farmers, out in the Midwest, the good old people out west, farming their land, farming crops or wheat or corn or even, I believe, livestock. This was a challenge that happened. I think it was some years ago. They kind of eliminated this death tax, but the old man would die, and then the farm would go into probate, and then people would pick it up at pennies on the dollar. But the death tax, talk about that dynamic, because the family, the daughter, the son, they say, okay, well, I'll take over the farm, but at the same time, they had this huge tax to pay.
Right. So that's when we start talking about, let's make sure our properties and what we own are sitting in a trust.
Right.
So now we don't have to recognize that death tax anymore.
Yeah.
Right. We can kind of skirt right around that. We can skirt around any kind of probates. We can skirt around, just any kind of additional income. So normally property, once you pass, is recognized at market value. So your mom owns a property, mom passes, and mom bought the property at 100. Well, right now it's worth 5.
Yeah.
Right, because mom bought it 30 years ago, 40 years ago, and now it's worth $500,000. Well, the IRS wants you to recognize that $500,000 as the purchase that you're getting, and so this is where all the taxes kind of come in, and where all those different this is where you kind of need those mechanisms in place to kind of avoid losing your tail, because maybe now at this point you're not able to afford your mom's property that she's had in the family for 30, 40 years, 60 years, whatever the case might be. You're not able to afford to take that over. And so what we do is we go about creating these trusts. Yeah.
So a trust, break it down, is it's another basically a way to recognize an entity, essentially, right? It's it's not an entity, but it's a vehicle that's going to. It also provides anonymity too, right?
It does, absolutely. Somewhat does give you some privacy there. There are a couple of different trusts. Some not as well known as others.
Okay.
There is your revocable and your irrevocable trust. Those are probably your most prominent. The most you kind of hear about. That revocable trust allows you to maintain all controls of the asset.
Okay.
Right? So you have a home and you'd like to go ahead and you'd like to put this home fully paid for in a trust.
Okay.
Right? For your beneficiaries, for your children, for your wife, for whoever.
That'll avoid the death tax. It will avoid the death tax,
but So there's a difference between revocable and irrevocable.
Okay.
With revocable, we might have some issues because it means that at any given time you can change your mind.
Known as a living trust, aka
Right.
living trust. Yep.
So you don't really; those aren't really the ones that really make sure that you're going to inherit that property tax free.
Okay.
You would need an irrevocable tax.
Okay.
Okay.
Yeah.
And so that irrevocable trust is what you would want in place, where you're not really allowed to make changes once you have assigned that property.
Okay.
As the guarantor, you have signed over that property over to the trust. You now put a trustee in place
Right.
to take care of that property.
Right.
The trustee, and here's the nice thing about the trust is your trust is run based on the rules you've created.
Right. Right.
And that's the part that most people miss.
Yeah. Yeah.
Right? So you create a trust, you deed your home over to it, we get all the paperwork done. That trust now owns the property.
Right. And everything you sign has to be signed as the trustee.
And everything has to be signed as the trustee, but it can be that, the trustee is getting a paycheck.
Right.
It can be that the trustee expenses are being paid through the trust.
Right.
Right, so there's so many different things that you can do with the trust as you have created them, that they give you so much leeway to kind of, again, get those tax advantages.
I like it.
Now, the thing about the trust is they're not cheap
Okay.
to put in
To set 'em up.
place. They're not cheap to put in place.
Yep.
They do require quite a bit of money to kind of put those in place. But for those people that don't want to deal with, oh my God, my property ended up in probate, my daughter is fighting, or both
Exactly.
my daughters are fighting, or all the kids, the siblings are fighting.
Yep.
How do you avoid that?
Yeah. Yeah, because it could cause a lot of damage within a family.
And then it ends up going to the state sometimes.
You lose out. The state loses.
I've seen plenty homes
Yep.
that end up the award of the state because, our families aren't able to get them because we did not properly set up those things in place
Yeah.
prior to our demise.
Yeah. That's interesting. And there's a Netflix movie that came out too. I was just thinking about it. I just watched it the other night, but it was something similar, but it was more along the lines of the ward is someone that takes care of the mother, the grandmother, et cetera, that's aging. So yeah, so revocable trust, irrevocable trust.
Right. So your revocable trust, it allows you to retain control of the assets, and you are free to revoke and change the terms at any time.
Okay.
So you don't necessarily get the tax benefits of that.
Oh, okay.
Right? That revocable trust, you don't get the tax benefits of it. You don't get the tax benefits until you do an irrevocable trust where you no longer own the property, the estate owns the property.
Okay. Well, that's very important.
And that, right. So, make sure we know what we're doing when we're
Yeah.
going in, right? Because, we're like, oh, I want to be in control because, it's mine. And as long as I'm alive, I want to be the person that has all the say so. Well,
Yeah.
there are some disadvantages to always having that say so
Yeah.
if what we're trying to do is to leave a legacy.
Yeah. Yeah, that's important.
Right? A lot of times we don't leave that legacy, right? That,
Yeah.
we gain and we do all this, and, we get in a place in life where, maybe it is at least comfortable at this point, and we don't make sure that our legacy is transferred to our kids and our grandkids in the proper way,
Yeah.
where they can now afford to have those and to build on, and they don't have to start from scratch the way we did.
Yeah, absolutely. One of the things I'm getting a lot of questions on, people say, hey, our great Congress up in Washington, they've printed lots of money lately. Lots and lots of money has been printed, and to the tune of $5 trillion roughly dollars right now, give or take. And then also there's another bill that's been proposed for another $2 trillion. So we're talking about $7 trillion worth of new U.S. dollars in currency, in circulation. What do you see happening? I mean, it seems like taxes have to go up for almost everybody.
I definitely see that. I see that with the stimulus. I noticed that this last tax credit, they're calling it an advance. So it's no longer a stimulus. I think those are the things that we have to be mindful of,
Yeah.
that the government needs to recoup everything that they've been handing out,
Yeah, exactly.
you know, and how do they do that?
And you're talking about trillions of dollars.
Right. How do we do that?
People don't realize, they don't. I heard this on one of my favorite, Tony Robbins, right? I went to his business
Yes.
mastery course.
like
I
him.
walked on fire. But I heard him on one of his CDs kind of break it down. And that shows my age, right? CDs. It says 1 million seconds ago was something like 2 weeks ago, 2 or 3 weeks ago. Trying to give perspective of 1 million versus 1 billion versus 1 trillion, right? So seconds ago, 1 million seconds ago was something like 2 or 3 weeks ago. 1 billion seconds ago was something like 30, 40 years ago, right? 1 trillion seconds ago was before Christ.
Right.
Okay, so 2 weeks, 30, 40 years before Christ.
Right.
I mean, that's the difference in dollars, because it's hard for our minds to wrap around the difference between 1 million, 1 billion, and 1 trillion.
Right.
And just until a few years ago, we started talking about trillions in Washington, D.C.
What is a trillion?
Exactly. People don't know. They say, "Oh yeah, the U.S. government's pretty big."
Right.
What's the total GDP, right?
Right, right.
And really, it's gross domestic service. We have a lot of service bases here in the United States. It's not as much product that we're making.
Right. But we do have quite a bit of service here that we
a
offer.
lot of service.
Definitely quite a bit of service. So I'm a bit skeptical
Yeah.
to
me
see
too.
what some of these changes will be in our government. But there has to be a way to recoup all the excess unemployments that were paid out,
Yep.
all the stimuluses that have been handed out, and you know, I'm waiting to see what that's going to look like, because you know, these pots have to all recoup what it is that
Yeah.
they've spent from whatever areas they've spent it in.
Yeah.
And one way to kind of make sure, again, personally, that we're okay is to create these trusts,
Yeah.
right? You go back to those trusts again. How do you keep your wealth? You keep your wealth within the trust.
Yeah.
You keep your wealth by creating a charitable trust.
There
You
you go.
keep your wealth by having a family trust.
Yeah.
Right? So there are different ways that you can go about, you know, I have a family trust. My family trust is in charge of paying my mortgage, you know, making sure everything is running right, all this other good stuff. And then I have a trust for my businesses, right? So you can even put your business in a trust.
That's a great idea.
Okay?
Yeah.
You put your business in your trust. Whatever is left over from the business, you no longer,
Oh.
Brandon, have to pay the taxes
Okay.
on the trust.
Yeah.
Right? Because the excess goes in your trust.
Yeah.
And so now that trust is able to kind of go ahead and orchestrate and pay all your bills and do all the different things and take the deduction.
Yeah.
Not to mention, remember, it is the rules that we put in place that these trusts are governed by.
Okay.
Right?
Yeah. So you do have control.
So you
can
have
set those-
control.
Yeah.
You do have some control, which is
Yeah.
what I'm getting to, even though they say you don't. There are rules. There's a contract that is set up with the terms of the agreements of how this trust should be run, and that's what you do.
Yep.
So you have your business trust. Your business trust transfers money to your family trust.
Yep.
Your family takes care of all the expenses. Your family do what they need to do, and then the family trust then transfers to the charitable trust.
Nice.
Well, the government says if you give 5%, that's all you're required to do to have a charitable trust. This
great.
is how our Bill Gates and everybody else
Yep.
are maintaining and keeping their funds.
Enormous
right?
wealth.
Absolutely.
Yep.
They're moving it from trust to trust to trust
Yep.
while complying
Yep.
with the IRS laws
Yep.
and the rules, right? We're just moving them along the line. And so now it goes into your charitable trust, and it can actually sit there, and your trust can always make a donation or can always do something, but your money is always there at that point.
Yeah. That's awesome. Well, I think we're getting close to wrapping here. Anything that we didn't cover? Oh, audits real quick before, because audits are probably going to increase because of what we just
Audits
talked
are going
about.
to increase. Oh,
Yeah.
there's no doubt.
Yeah.
While I don't see it really big in the news, audits are going to increase to a whole new level, right? All this PPP loans, there has to be a way to reconcile all that.
Right.
And the only way the IRS is going to reconcile that is to ensure that they're looking at your tax return.
Yep.
So that $20,000 that you received in PPP, let me see your $100,000 in income.
Yeah. Yeah.
And so I definitely believe that we will see an increase in audits. I believe that, and everybody's working from home and, well, I can't take the home office expense, and that's a dangerous credit to take.
Yeah.
That home office expense is dangerous, right?
Oh, okay.
Because there are rules to that. You have to be able to allow someone to, get access to your office, right? And so there are some rules to having that home office.
Okay.
And once we're not adhering to those rules, then they're saying that the home office expense is not really deductible. Well, as business owners, of course, we can go, listen, we are using an entire office, and I see it here,
Yep.
right? It's a complete office. There's no beds in here.
Right.
There are no day beds laying here in your office, right? And so in your office, when we start talking about, well, is this considered an office? You then start talking about, well, can this be deductible? We start talking about the total square footage of the home versus the square footage of the office. And so all the deductions, all the maintenance of this beautiful property that you do own here now becomes a tax deduction,
Right.
Based on the percentage of the office.
That's great.
Yeah.
So audits, anything else that we covered? I mean, we covered a lot there, Michelle. And again, thanks for, allowing access, to all this information. I mean, and some of the stuff we went a little deeper on the others. So people, if you want to reach out, we'd love to put you in touch with Michelle. She's our local, again, we could say our expert contributor for the Consumer Quarterback Show. Anything that you wanted to mention that we didn't get to or that's topical right now?
I tell people, talk to an expert.
Yeah.
If you're anything besides a W-2, you should not be doing your own tax return.
Right.
Right? If you are a family, if you have a small business, if you are making over, $100,000, you need to be talking to someone else. You really don't need to be going on TurboTax because TurboTax is not a good guide.
Yep.
What TurboTax does is it calculates a tax return.
You're leaving money on the table.
You're leaving so much money on the table.
Yep.
And any person out here can calculate a tax return, but how do we get you to save on those tax dollars? That's the part that they're missing when they don't reach out to the experts and people that have experience in this area.
That's right. We can offer a review as well. Michelle will spend about 20 minutes with a review, and she'll give you an email, a secure email, and a system that she has to send over your documents. So if you want to get a review of your taxes and what you've been paying for the last couple of years, last up to 3 years, she can do a review and also see if maybe you left money on the table. Maybe there's money sitting there. Wouldn't that be nice, right? You got money sitting there from a year or two ago.
There usually is.
There usually is.
There usually is money sitting there.
So we'll get a review done for you as well. You want to give your website information as well?
Sure. So it's Michelle James of Taxpro of Tampa. The office is located at 3420 South Dale Mabry Highway, Suite S as in Sam, Tampa, Florida, 33626. Our telephone number is 813-831-6100, and our website is www.taxproftampa.com. So it is Taxpro of Tampa. It will definitely look like tax proof because we are going to prove those numbers.
Yeah, I like that. Taxpro of Tampa.
Taxpro of Tampa.
Perfect. All right. Well, hey, thanks so much for joining us. If you enjoyed this video, would you please like and share it with your friends? Check out our podcast as well on Apple iTunes. We've got our podcast there. On YouTube, our YouTube channel, over 1,200 videos now that we've accumulated over the years, and lots of great experts with the Consumer Quarterback Show. We've got experts for a lot of different categories, almost every category of business and life and health, everything ranging from home services, solar companies, all types of great attorneys with different specializations, family law to real estate law and more. So we'd love to help you as a consumer advocate as well. And again, our hotline is 813-750-0550. It's a call or text line, 813-750-0550. And of course, the Platinum MVP team at Keller Williams Realty is my wife Lindsay and I's company. We are a top 1% ranked real estate team here in Tampa Bay. Out of 25,000 realtors in the area, we rank in the top 200. So we'd love to talk to you about that. PlatinumMVPteam.kw.com is the real estate website. It's a hot market right now on the real estate side as well. You're seeing multiple offers. People are coming back looking for, and we talked about, we kind of alluded to that earlier, is, people will look for ways to improve their income and show more money from last year so they can qualify for the house.
Yes. Are they bidding over the asking price here?
Yeah.
Are they? My son is in New Jersey and he's like, Ma, I have to bid like 40, 50,000. I was like, we will not.
Yeah, and because they're leaving New York to New Jersey. I mean, so it's funny to see the migration patterns. A lot of blue states to red states, coming down. But yeah, that's interesting. I've read about that one too. People leaving New York and New York City for Jersey because you get a little bit more land or it's a little bit more rural.
My son has been trying to buy a property and he has just not had any luck. I mean, if the house is selling for $350, we can't go in less than $400.
Yeah, and that's where you got to look at a good real estate agent. There's some things they can do with the different addendums that you can use, escalation clauses, things of that nature. So there's strategy behind it. Yeah, he's
like, Ma, I have to. And I was like, no, you don't. And so we're like, but yeah, I do realize that. I did not realize that was also here now.
Yeah.
That we're actually bidding over the asking price.
$800,000, almost $900,000 listing I've got had multiple offers on it already too. So it's not just at the $300,000 or $400,000 price point. You're talking about $800,000, $900,000 homes getting multiple offers.
Wow.
Yeah, it's amazing.
That is awesome. Well, I thank you for having me here
pleasure.
today. It was actually my pleasure. I actually enjoyed this.
Yeah.
Being outside was nice, quite relaxing.
What a great day, right? Nice breeze.
It is a beautiful day.
Yeah.
Do you all see the view behind us?
Yeah, check it out.
Do you all see that?
That's Lake Tarpon. That's a 2,500 acre lake.
Oh my God.
It's one of the largest in Central Florida.
Beautiful. Yeah. Thank you so much for having me today.
My pleasure. Good to have you. All right, please go out there and consider committing a random act of kindness. Do something kind for one another. Be a force for good in the community. And we'll see you next time on the Consumer Quarterback Show.